Welcome back to the Long Put Masterclass. My name is Stephen Cox and I'm the CEO of Share Navigator and I'm a full-time options and futures trader. This is episode 5 of a 6-episode series on the long put strategy. So far, we've used NVDA, the $218 put option, as an example, and we've showed you what our maximum profit is going to be, what our break-even price is going to be, what our maximum loss is going to be. We've benchmarked the long put strategy versus shorting the stock outright, and we've shown you how buying put options is more capital efficient than shorting the stock. We've also discussed some of the Greeks, delta and theta, theta being the enemy of option buyers. In today's episode, we're going to cover gamma and Vega. Gamma is the rate of change at delta, and Vega is a measure of volatility and how an option's price will change relative to an increase in volatility. So we'd like to stress and emphasize at this point, not to stress about the Greeks. You do need to know what they are and what they mean, but in terms of the mathematical calculations, they're all done for you usually through your online broker. We're going to show you in the final episode how to use the profit and loss tables with your online broker that will show you what your profit or loss will be in any option trade for a given move in the share price. So it's just important to point out at this stage that delta, which we've discussed already, doesn't stay stagnant. It's constantly moving every day as the share price moves up and down. So the rate at which delta moves is gamma, and gamma is the change in delta for every $1 change in the underlying stock price. So you can see here, for example, that the gamma on our NVIDIA put option is 0.010. This means that if NVIDIA drops by $1 to 192.02, our delta becomes minus 0.694 minus 0.01, which is minus 0.704. So that's moved in our favor. We want the negative value of delta increase when we own a put option. And vice versa, when it rises by $1, the value of our delta will actually decrease from the negative value that it's at now, working against us. So we're said to be long gamma. When we discussed the pricing of an option in our basic introduction to options course, we discussed how important implied volatility is. So implied volatility is that unknown volatility that may come maybe at an earnings announcement, for example, and it's expressed in a percentage term. And the higher the implied volatility, the higher the option price, and vice versa. So Vega is a measure, and it measures how much an options price will change for every 1% change in an options implied volatility. So you can see on our option quote screen here for NVIDIA, for our put option, the current implied volatility is 42.2%. So if that changed by 1%, you can see the Vega figure beside it is 0.302. So for every 1% change in implied volatility, the value of our option will actually move up or down by $30.20 per contract. So that's how important implied volatility is to an options price. So we've mentioned over and over again that timing is everything when buying any type of option. And with implied volatility, it's critically important that you understand that when you buy when implied volatility is low, you're buying the option cheaper. And you try and exit when implied volatility is high, if possible. So great examples of when IV tends to increase is around, we're coming up to earnings. We don't know what the company's going to say, whether they had a good quarter or a bad quarter. So the option prices tend to increase coming into an earnings period. So there's this IV rank feature on most trading platforms that you can look at, and it tells you in percentage terms what percentage it's at in terms of the implied volatility for the last 52 weeks. So you want to see the IV rank being as low as possible. So at the moment, the IV rank on NVIDIA is at about 29%. So it's quite low. So buying options now on NVIDIA is not a bad thing from an implied volatility perspective. If the rank was closer to 70, for example, we wouldn't be advocating buying options. And it's just as a word of caution, I've seen with people, where they have only got a little bit of knowledge, where they buy an option when IV rank is high, the share price moves up and they still lose on their option. And that's just down to the fact they pay too much time value for that option. So even though they got their direction correct, and the share price moved in their favor, because they paid too much for the option at the outset, that's the reason why they may have lost money on that call option or put option. So, implied volatility is a very, very important part for you to pay attention to when you're buying options. When we get into selling options, we love when IV is high, but when you're buying options, you want IV to be low. So that's it for gamma and Vega. So gamma simply is the rate of change of delta for a given move in the share price. And Vega is a given move in the option premium for a 1% move in implied volatility. And we discussed again, just to reiterate, you want to be buying options when implied volatility is low and selling options when implied volatility is high. And we can keep it that simple. Again, just to stress, you don't need to do the maths on this. This will be done for you in the profit and loss tables. We're going to show you how they're done in the next video. And it's quite simple, really. But you just need to understand, and the key ones to understand are your delta, your theta, which is the enemy of an option buyer. And you need to understand a bit about implied volatility as well, and how important it is to an option buyer and indeed an option seller. So in the next episode, we're going to cover the trade management from the very buying the put option, what strikes do we pick, why do we pick it, looking at IV rank. We're going to show you how to do all of that. And then when you've actually bought the put option, what's your trade management going to be? But again, if you'd like to fast track your learning, please try out our mentoring service. You can try it free for 1 week. Details are on the next page. I will work with you one-to-one and work with you at your pace and in your time. And this is simply the best way for you to learn in a safe and supportive environment.